All right. Other income. Let's get going on this. Other income. There is no such thing. Forget it. No. It doesn't work that way. You know. Yeah. That was a short lesson, wasn't it? No.
Yeah.
Other income. Does anybody have an idea what other income means?
Other stuff.
Other
Not normal.
stuff. Not normal income. What would, okay, let's put it
Jury
this way.
duty.
Okay, let's put it this way. What's ordinary income?
Wages.
Tips.
Wages and tips. Something on a good old-fashioned W-2, pretty much. 1099 or W-2, pretty straightforward. Means you went to a job, you punched in, came home, that sort of thing. You got paid regular U.S. dollars, and that's about it. But in contrast to that, there are a lot of other ways you can get paid. And it counts as different types of income. And a lot of people have to understand that they think that it doesn't count. The biggest one was actually the last one we were talking about is Social Security. As you know, half the world pretty much goes, well, it's my Social Security. I don't get taxed on that. Oh, yeah. Depends upon how much money you make.
Mm-hmm.
And they don't like that. But that is income. And, you know, and it doesn't matter. That's why it's called a benefit. It's not called an income. It would be your Social Security income. It's a benefit. Or your Social Security rights, if it was, you know. So, other income. You have other sources of income which come in from all different aspects. You have income which come in from dividends. You have income which come in from annuities. You have income which come in from alimony. You have income which come in from passive income. You have income which come in from charitable income. You name it. Okay? You have things which are given to you. You have things which you earn. You have things which are from investments. The number of ways that money can come to you is almost limitless. Okay? What are some of the ways you can make money? Come on, ladies. What are some of the ways you can make money?
Are you talking self-employment or just
Well, just
other?
what are, no, I mean just other.
Garage sales?
Garage sales. That's
Selling
Robbing
income.
a
every
bank.
day.
Interest on your checking account. Who knows? Okay, what else? Say having a bake sale.
Yeah.
There you go.
So,
Robbing a bank.
Robbing a bank. Actually, that's actually a very good one.
I know. I read it.
Drug sales.
Right.
Okay. What is really important about drug sales?
Still have to count it as income.
Still have to count it as income.
Yep.
What happens if you're a drug dealer
No
and you
one
don't report?
does.
Well, I mean, you'd have to be.
They'll come after you like Al Capone.
Al Capone. That's why he went to prison in Joliet. He
Right.
did not go on the other. He went on tax evasion.
It gets really interesting between Oregon and feds with marijuana.
Mm-hmm.
Well, now
That's
it's
a
legal,
really good
so.
one. No, it doesn't
That's a
matter.
whole
It is not. It is not a legal drug. The sale and growth of marijuana within the state of Oregon is considered legal by the state of Oregon. It is still a federally regulated drug
This
and
is
illegal.
true.
So
Yeah.
it is an illegal drug sale. So how do you handle that one? Because where does it go on your taxes?
It depends. Are you talking feds or Oregon?
Well, no, on your federal taxes. You have to report federal taxes.
It can't be
on it.
Other
self-employed.
income or farming, I guess, maybe.
It's not legal, so you'd have to put it under other income.
Has to go into other income.
And you can't have any expenses. But on your Oregon tax return, you can count it as self-employment with expenses.
She's learning quick.
Woo!
Marijuana sales. Marijuana sales are considered other income because it is legal in the state of Oregon and you can go to jail for it federally.
That's why they keep everything in cash.
Yep. Has to be cash sales.
Yeah.
Aha.
Because the banks won't loan
They
to them.
won't. The bank will not. The bank will not allow you to open an account. Not under that business.
Bummer.
So you basically have to do like tax return with the feds As
It's
if
counted as
you're-
other income,
as
but
if
you
it's
have to
still-
report it. What happens if you don't report it?
Jail time.
Jail time. What happens if you do report it?
Jail
Jail
time.
time.
Jail time. Federal.
You don't have to say what it is.
No, you have to report it as other income.
Planting.
What
plant
happens?
Sales.
What happens? Yeah, plant sales. What are you doing? Harvesting, agricultural. So what happens though if you do not report it and it's considered to then the state of Oregon? What is it considered?
It's
Income.
income.
It's
legal
income, but what happens if you decide you're not going to report it?
Oh, they'll come after you with a big stick.
The state of Oregon will come after you.
Vinny
Right.
Linguido will break your kneecaps.
There you go. The state of Oregon will come after you. Even though it's considered legal, the state of Oregon will come after you then.
Mm-hmm.
But so think about that, and we have a special situation with that. We have to learn marijuana handling.
Because you can take the expenses on Oregon, but you can't take it on Fed.
That's right. But can you not can you not take it on the Fed?
I was told since it's not legal, you wouldn't be able to take it on Fed. It's the expense part of it.
Are you sure?
They do what
No,
now?
I'm not. Because you just said that. So that's what I was told.
It's considered an agricultural product, so part of it can be.
But it's an illegal agricultural product on Fed.
That's true.
I
But
was told
you
can't
can,
take expenses on illegal income.
yeah, but you can actually, depends on what aspect it is. So you can have the buying and sale of the support products, because what happens if you're a company that sells the grow products?
Like the plants themselves.
No, not the plants, but what about the actual grow lights and all that they use?
But yeah,
Oh.
that's not illegal. Paraphernalia is not illegal at all.
But what happens when you're selling them to a grow company, to a marijuana company? You're selling
Shouldn't
them
be
for
illegal.
illegal. You're selling them for illegal use, for a known illegal use. Here's the point: you're selling them for a known illegal use.
Well, what about the people in other states who sell bongs? I mean, hello, we all know people are gonna be smoking marijuana with it.
That's a glass thing. That's not. Yeah, but it doesn't matter. That's not an illegal. It's not an illegal act. You are performing
Right,
an
that's
illegal.
what I'm saying. So the other shouldn't be an illegal act either.
The other is an illegal act, though. You are selling a grow product to grow an illegal plant. A known act. See, the difference is this.
Where's the
In that
train?
case, the bong is not illegal to sell. It is a glass piece of smoking paraphernalia. There's
Mhm.
nothing illegal about it. But if you are selling grow material to a grow company, which is growing a marijuana grow company, you are
Mhm.
selling grow paraphernalia for the use of growing an illegal substance.
Well, how do you prove that that's what they're selling them for? Maybe they're doing,
Are you selling it to an illegal company?
I don't know.
Are
What
you
if you don't
selling the
ask?
materials? You know that you're selling it to an illegal company. You know it's not
For all I
being
know, they're
reported.
growing tomatoes indoors.
Are they providing? Are you? Remember, you have to provide the receipt and all that. Who do you provide the receipt to? Remember, there's a transaction here.
Mhm.
Okay.
Jim's
You
Tomato
are-
Shop.
So what happens? Because there's a big difference here. You just said that that in other states, you are selling a bong that you don't know that they are using it for marijuana sale, for smoking marijuana. But when you are selling the grow equipment,
I don't know
especially
that either.
yes, you do. You know you're selling it to a marijuana growth company.
Yeah, I know I'm selling it to somebody. Somebody could come in completely high and I can sell them a bong, but I don't know what they're going to use it for.
That's not my point. My point is, you do know that you, as a business-to-business company, because you are selling it to a manufacturer, a
Mhm.
company that is a known.
Is that the difference because it's business to business and not business to
There you go.
consumer?
There you
Uh-huh.
go. You are selling it to a known producer of marijuana.
Okay, well,
Okay.
I'll just remember that's the rule, and even though it doesn't make sense.
So it doesn't have to make sense. You are breaking basically a federal law. So it doesn't matter that you are.
So maybe I don't want to sell it to a company then?
Well, here's the problem. When you sell it to another company, don't you? I mean, you have to track the transaction, correct?
Yeah.
Who do you track that transaction to on the invoice?
Well, if it's illegal in
company.
your area, you should do it by cash.
Right.
Do those companies operate, the grow companies, the ones that actually supply that material, go on cash?
They shouldn't.
They usually don't. So
I don't know. I do
there's a
individual
transaction.
taxes. I don't do corporations.
Yes, you do.
I want to pass the
Yes.
LCC.
When is the last time a sole proprietorship was considered a corporate? Sole proprietorship is an individual tax return.
Yeah.
And if I own a grow shop, if I own a pot shop, congratulations, you just performed an illegal act supporting a pot shop. See, the problem is you're getting into a very gray area. And even though you are trying to work on something, and I know you're trying to justify it, and I understand that. But the problem is,
for all my clients.
But the problem is, there are certain times that you are actually performing an illegal act.
Yeah, I've never done a tax return like that at all. So.
Well, I actually have. I've actually had to do some marijuana grow tax returns. And especially up here, we have lots of them.
Well, yeah, we do down
south. And so, here's the thing.
The South Jackson Hewitt's right next to a vape shop.
Oh, yeah. We have a bunch. The McMinnville one literally shares the door right next to one. Shares the door, more or less.
Yeah, we do too.
Every time they're cleaning the bongs next door, I know. Hear it on the wall.
Yeah.
I have a vape shop on one side and two marijuana shops on the other side.
Yep. Because unfortunately, a lot of where our stores are, a lot of them share them in some of the lower end malls where we do have a lot of marijuana stores within those areas. But remember, we have to account for that income and that sale. So when we indicate where that product went to, when they audit you, that's federal. So, think about it. Those other incomes you just supplied against a federal tax return that you had income supporting an illegal act. Now, the feds have not prosecuted anybody based on it because they've allowed the states to make that decision on their own and have not pursued it. But what happens when somebody gets into office who maybe decides that they really do want to pursue it? Colorado, Oregon, all these states that have allowed it, Washington, they could be in a world of hurt because the U.S. Marshals are actually separate from.
When you get a tax lawyer.
So, because you can actually go to prison then on federal charges. Because taxes are federal. Taxes are not state.
Who's going to prison?
The people.
But the preparer wouldn't.
Actually, here's the problem. Are you knowledgeable about the activity?
Well, if you put it in there correctly, I guess you would be.
Yep. Congratulations. If you know what the activity is as to what they're growing, what they're doing, guess what? You are now complacent.
But they have to.
That's what your signature.
So you have to put it in.
Well, that's what your signature is, though. You could actually turn down the tax return.
Wait, are
Because
we
they're
talking about
activities.
not being able to take expenses or having to claim income? Because you have to claim the income of illegal activity.
You have to claim the income, correct?
Mhm.
So then, why would we get in trouble for doing a tax return with illegal income on
What
it?
is one of the one things that you have to report with income that you're supposed to report with income?
Expenses.
No, what happens if the income comes from a source which is considered a questionable source? This is especially true with other income. That's why I'm asking you.
You have to
Oh, no.
report it, that they have illegal
There you
income.
go. It's called a SARS.
Well,
Suspicious
profiler has to
It's
activity.
find
kind of like,
illegal income.
It's
if you're,
called a suspicious activity report.
so it's sort of like you're a therapist and you have to report your clients.
Having committed an illegal
yeah.
act. There you
Who
go.
do you report it to?
You actually have to report it to the, well, technically to the feds.
The
It's
IRS.
the IRS who gets it, but it's
Is that
called a
where that
SARS
portion
report.
of profiler? Is that what that does?
Hmm That's
The
when
illegal
you
portion?
say that it's suspicious activity report. It's called
I haven't
SARS.
seen that part. I've just seen the part that says illegal income. So if
Hmm
I click on that,
Yes.
is that what it'll go through?
That's what it'll go through.
Profiler?
Yep.
Okay.
But that's really important in a lot of cases because actually, if you are from one of the companies where illegal activities occur on a regular basis, like
Mhm.
the casino, they actually expect a certain percentage of those reports to be made every day.
Ew.
And if you don't, then the gaming commission actually comes and starts to investigate
Hmm.
because they expect a certain percentage of those reports every single day because they know that they will be money laundering, there will be things like that. So with other income, think about it. What happens when you have these people who have income from grows? That's what other income means, by the way. So sources that are out of the ordinary. Okay. So what are some of the legal sources? Now that we're off of the illegal sources, gun trafficking is probably not one of the ones we want to get into, but in Oregon, ironically enough, it's legal in the state, but illegal federally. Okay, marijuana. That's why it has to go under other income. Okay, so what are some of the other sources? Where would you expect money to come from?
Jury duty's one, I guess.
Jury duty,
Gambling.
gambling,
Cancellation of debt.
cancellation of debt. That's a big one, actually.
Yeah.
That was really big when all the foreclosures were
Yeah.
happening. People hated those things because they didn't know what they were. Well, congratulations, you just canceled how many thousands of dollars in your house, and you figured, oh, I don't owe it anymore. Oh, yes, you do. So, cancellation of debt. What are some of the other ones?
Tribal
Oh.
income.
What's that?
Tribal
Yes.
income.
You cut out there, Beth. I'm sorry.
Tribal income.
Tribal income. That one's a big one. Especially now. They just got their first couple of years worth at ALNA.
Prizes, awards.
Prizes,
Advertising
awards, you name it. Oprah Winfrey giving away those cars. Man, that was the first time that ever really happened on national TV. They thought it was the coolest thing in the world. She was on national TV, and it was in the 90s when she did it. I can't remember when it was, when it first happened. And they thought it was the coolest thing in the world. Everybody here, she was talking about how she wants to help everybody out and all
So
this.
you get the 1099 in the mail.
And no, it was much worse than that. It doesn't work that way. It doesn't work that way when you get a prize like that. At the actual payout, the tax man expects it. That's an estimated tax. You have to pay that up front. You don't get that kind of an income at one time and not have to pay tax up front. So what happens is as you are standing there, they give you this wonderful car. Everyone in the audience was given a brand new car. And they went, oh my God, this is the greatest thing ever. Until they realize that before you can take it, standing there by the door, waiting for you to come out, was the tax IRS agent. Okay, thank you. That is awesome. I'm so glad you just won that car. We'll take it. It was about a $6,000 check right now. And they went, say what? Yeah, that's your tax on that income that you just made. So you can now pay that right now. And they went, say what? You cannot get that large of an income and not have it withheld immediately.
What's the cutoff?
So as a result, they were like, wait a minute. So we have to pay $6,000 on our new cars? Yeah, you get to pay, that's income to you. You get to pay the fair market value, which we actually happen to know the market value because it's the actual purchase price. You have to pay your portion of the taxes as a result of it because it's income to you. It has to be withheld, and it's basically the 20%, which you are now going to pay to the IRS. And all of these people, and there was, I can't remember how many hundred in the audience, had $6,000 or so that they all owed. And they went, so luckily what Oprah did was, and instead was, she goes, you could take the cash equivalent and we'll make it instead the cash. That's where basically the cash equivalent became really popular. We'll let you take the cash equivalent instead, and we'll do that so you can pay the taxes on it instead if you prefer.
So what's the cutoff?
What do you mean?
Like, how big a prize can you win before you have to pay the taxes?
There is no cutoff. It's called a jackpot. What happens is anytime there is a jackpot, which is anytime there is a prize which is considered above a standard payout, like a one-on-one payout. So if you're making a regular bet in an award situation, and anytime you are granted like a gift, like the car, it's considered a jackpot payout. So there is no minimum. It can be $1,000. It can be $50,000. It can be $500.
But if, like my client who got a prize for, or an award or whatever for opening up the bank account, she got an iPod, and she got a 1099 later. She didn't pay the tax up front.
No, if you're going to pay it with withholding, the withholding is basically $1,000. That's the point where the withholding, where they actually the law is for the casino is anytime it's considered a jackpot payout. So it's considered $500 or more. They have to pay. They have to withhold the tax.
Okay.
What about a GoFundMe account?
GoFundMe, they have to withhold it pretty much no matter what, no matter how much the amount.
So whoever is handling that
Yeah,
GoFundMe,
the people who handle the GoFundMe, when they take it out and actually pay it out, they withhold the taxes automatically.
but isn't that other income?
Actually, I think it's other income because it's a charitable contribution.
Years ago, there used to not be any rules on that.
Well, yeah, there are lots of them now.
Canada had rules on that before we did.
But anytime at the casino, it's considered a payout wherein it's paying basically greater than, I think it's 3-to-1 or 5-to-1. I can't remember what the payout amount was. I think it was anytime it's over. I got to check with Shell because she has all the guidelines. But I think it's anytime it's over 5-to-1. It's considered automatically a jackpot payout. But so whenever your odds are a certain amount above it, because even here's the best part: if you hit the bonuses where it pays like the 30-to-1 on craps, or if you hit the 30-to-1 like on Baccarat, if you see, or the blackjack tables with the lucky ladies and that sort of thing, and you hit the lucky ladies and it's 30-to-1, those sort of things. Guess what? Those are considered blackjack. Those are considered jackpots. They withhold tax right to start. You don't get it right away. They stop the game and have to pay it out as a blackjack. That's all gambling income, and it all gets reported as, well, it's gambling income. So that's how it ends up being reported to you. It's a W-2G. But anytime you have other income, I mean, like I said, you have to consider the source of the income. So let's get into some of the most common ones that are not so far out of the ordinary. Okay, taxable state refunds. Most people think that they're state refunds, why is that taxable? And they hate that fact. Why would a state refund be taxable? It's my refund. Well, because it's considered state income. It's considered state income. Income from the state. It's not income from the Fed. The only place that it's not deductible, not taxable, is federal refunds. State incomes, guess what? Why is that? Why do you think state refunds are considered taxable?
The benefit.
No. Why would state incomes be taxable? Why would an Oregon state refund be taxable, but a Washington state refund not be taxable?
Don't know.
Because there are no Washington state refunds.
Yeah, really.
You're trying to trick us.
Because Oregon has income tax for the state, and there is no income tax in Washington. So as a result, it's considered a payment from the state of Oregon for activities. So guess what? Same reason why, what can you do on your taxes for sales tax?
Right. You get the benefit of it. You have to.
There you go. You have to apply it to your itemized deductions. So it's considered income to you. And so you can also, if you itemized, you can claim the deduction. Okay? So taxable state refunds, that's why they're taxable. Not all states have them as a result. Okay? Not all states have income tax. That's why I ask you. Washington state refund. Well, it's easy. There is no Washington state refund.
Yeah. There's like 7 states that don't.
Yep. So, as a result, they tax state refunds. You can get a refund. The feds can tax it. It's income to you. So when a taxpayer itemizes, they can deduct the amounts they spend on specific goods and services, such as property tax and charitable contributions, from their taxable income too. Okay, that's how they deduct it when they itemize. Okay. Now, that's also one of the reasons why they increase the standard deduction. Why? Because a lot of people are getting a lot of contributions there off the itemized deductions. Okay. So, taxable state refunds. Taxpayers who itemize can deduct the amount of state and local income taxes they pay through withholding or estimated tax payments. Okay, that's really important. The estimated tax payments, whenever you have a business expense, or should I put it like a large income like that, you have estimated tax. Okay, like the Oprah Winfrey bonus, you would have an estimated tax payment. Okay. When the taxpayer receives a reimbursement or refund for an amount they had previously claimed as an itemized deduction, it's called a recovery. Guess what? recoveries are included in their income. Why would that be? Why would you include a recovery?
Because you had a benefit at one point.
That's right. So it was, you had it as an itemized deduction. Now it is now being reimbursed. So it's considered income again. You had it as an itemized deduction. So that's why it's now considered part of your income.
Like
So
depreciation.
there you go. State tax refunds are one of the most common recoveries. Because think about it. You paid taxes on it. You put it out there. You get that refund. So it came back to you. You deducted it. Okay. You're getting that refund back. So you get it back. So you get taxed on it again. Okay. It's kind of like a vicious cycle, basically.
Yeah, it sounds like it's sort of like a 1099, well, like a canceled debt that someone owes you, and then if they repay it or something.
Yes, kind of like that, yes. So let's take a look at the example they've got here. Troy itemized deductions on his 2017 federal return and took a deduction for the 2017 state taxes he paid. In 2018, he received a refund from his 2017 state tax return. Depending on his situation, Troy may have to include his state refund on income on his 2018 federal tax return.
Yep.
That's a given. Okay. The taxpayer should receive a Form 1099-G, certain government payments with their state tax refund. And that'll show their refund amount in box 2. Okay, so people should get a 1099-G, certain government payments. Who actually named this thing, though? I have no idea. Why they would call it certain government payments, I have no idea. But that is what would come to you as a 1099-G.
Well, there's other government stuff that comes.
Other government payments, true.
Unemployment.
Okay. Now, none of the state refund is taxable if in the year the taxpayer paid the tax, they did either of the following. If they did not itemize their deductions, and they itemized and did not deduct the state income tax. Pretty much if they did not claim it, in other words. Because that's the only way they would have claimed the state tax, is if they itemized and claimed the state income tax. So there is a state and local income tax refund worksheet, line 10, to determine whether any of the refund is taxable. And it's really easy. You put the taxable amount of the refunds on Schedule 1, line 10 of the 1040. I see you guys frantically taking notes, so I'll give you a second there. At least Pam and Pam are. Beth, I think, has got that one down pretty much. Now, I realize that the first one of this is state refunds. It's kind of a pain in the butt having Oregon have state tax, but there are only a few states that don't. So Washington being one, it's really cool having Washington be a non-state tax, non-taxable income state. You know, like I said, the best thing you ever do is work in Washington, live in Washington, and shop in Oregon. So.
Yep. Thanks for taking advantage of our state.
There you go. So Nigel Williams filed his 2017 tax refund and received a $200 refund in 2018. Nigel's filing status on his 2017 return was single. Total itemized deductions from his 2017 Schedule A itemized deductions, line 29, are $8,525, which includes the state income taxes of $11.97. Nigel received a taxable pension of $18,471 in 2017. He has no other income. Now, if you're able to follow all of that, basically it comes down to he received $200 as a state refund. Okay? So let's see where everything falls. So up here, enter the amount of the refund from the 1099-G, $2,000. Enter the total itemized deductions from line 29, $8,525. All right. Enter the amount shown below for your filing status. So we got single, 6,350 right there. Did you fill in? No. So enter 0. So it's 6,350. All right. Is the amount on line 5 less than the amount on line 2? Yes, it is. Subtract line 5 from line 2. Last time I checked, that was a different amount of $2,175. Yep, something like that. Okay, now, so enter the taxable amount. So, is this one smaller of these two? Enter the smaller of the two. So $200, smaller amount. This is a very simple form, ladies. It's not really hard. And by the way, Profiler does it for you. So it's going to know all the numbers. The only bad thing is Profiler is not available to you when you are taking the test. So
that's really the whole issue on the test.
Profiler is not there for you. So
Right.
you will need to be able to figure this one out. So follow through the form because I think there usually is one of these on there, especially from Oregon, because they know they're an Oregon tax. So there's usually one of these on there, by the way. Figuring out the taxable amount of state refund. So I can honestly say this is something you want to know how to do. And really, let's be honest, it's not that hard. Okay? It's a straight up form. Your numbers are coming from very basic areas. $200. That was how much was your state refund. That's right off of your itemized deductions. This is literally from here. Did you fill in line of the 1040? No. Okay, so this number is this number. Okay, very simple. Is this amount, subtract this from this. Very simple. Okay. This is not a hard form. This is really a simple form. And it asks, what is the taxable amount? $200. Which is smaller, this one or this one? Well, $200 is definitely smaller. Okay, that's all there is to this. It's not a complicated form. It's not a complicated approach. It's very, very simple. So I know you guys can get through that, but I do know that there is usually one of these questions on the test. Because with Oregon being a tax state, they almost always have at least one of these on the test. All right. We clear on this one?
Mm-hmm.
Yep.
Okay. All right. Stanley and Jonita are married. They filed joint federal and state returns for 2017, and their total itemized deductions for their 2017 Schedule A, line 29, are $18,501, which includes state income taxes of $3,823. They received the 1099-G shown below. They had, as you can see here, $1,762 for a state refund. Okay?
Mhm.
Very simple. So, is their state refund potentially subject to federal tax on their federal return?
Yes.
Yes. The answer is yes. Okay. A prior year state refund may be taxable in the year received if the taxpayer itemized deductions in the prior year. The taxpayer uses the same filing status in the previous and current years. The taxpayer's current year income did not change significantly from the previous year. The taxpayer itemizes deductions in the current year. So what do you think? The most important one is the taxpayer itemized deductions in the prior year. It doesn't matter
Right.
so much what you did in this year. It's because you itemized it in the previous year.
Mm-hmm.
So they itemized deductions in the prior year. Okay. Taxable state refunds are reported on Schedule A.
Schedule 1, line 10. I just
There
read
you
that.
go. She knocked that one out.
It's because
Wendy,
I just read it.
you just read it. There you go.
Oh, 5 minutes ago.
There you go. Wendy filed her 27th state return and received a $10 refund. Wow, $10 refund on her
Whoa.
in 2018. Her filing status in 2017 was head of household. Total itemized deductions for Wendy's Schedule A, line 29, were $11,744, which does not include state income taxes. How much of Wendy's state refund is taxable on her 2018 tax return?
Zero.
Zero. Why is that?
Because she didn't include the state
She
income
did not
tax.
include the state income taxes. She didn't include it, so it doesn't count. Okay. We are out of the state income tax.
Yay.
We are into, yeah, because it's kind of a stupid thing to be taxed on,
It is.
I think. But that's just
I got
my
a
own.
question.
What's that?
I noticed a lot of this is 2017. When are we going to switch to 2018?
We're going to actually update that shortly, but there's not, actually the truth is there's not that much difference, only in the final numbers. So that's the only thing that's different.
Well, and the schedules and all that.
Yeah, so we're going
They
to
only have a
actually
week
start
left
updating.
until they're going to switch the test to 2008.
Yeah, but we'll go through it and start to update it here. I got to start pulling all the current schedules. So,
Okay.
all right. So, alimony. Have any of you guys ever had or had to pay alimony?
Nope.
On tax return, yeah, not personally.
Alimony is one of the most bizarre things I've. It's when one person's the major income earner in the side of a marriage and the other one's not, and you end up having to pay them. It is considered income, by the way,
Right.
for that person, and it makes life really interesting. So, alimony is a payment to or from a spouse or a former spouse under a divorce or separation instrument. Payments must meet certain requirements to be considered alimony. If these payments can be deducted by the paying spouse, they are deductible to the receiving spouse, which is interesting. If these payments can be deducted by the paying spouse, they are deductible to the receiving spouse. So let's see exactly what that means. So, payments are alimony if all of the following are true. Payments are required by a divorce or separation instrument. The payer and the recipient do not file a joint return with each other. Okay, so they are actually considered divorced. It's possible they are married, filing separately, if there is a separation instrument. Payment is in cash. Okay, now by cash,
Oh, checks or money orders.
checks or money orders. Okay, so it's a direct payment kind of instrument. In other words, you're paying them directly. You're not giving them
No credit card.
no credit card payment, or you're not giving them a piece of art. You're not giving them. That's not considered alimony. You got the house. You've gotten your alimony. No, it doesn't work that way.
This law has changed.
So, payment is in cash. Payment is not designated in the instrument as not alimony. In other words, there are certain things which say you are required to pay a dollar amount to these people, and they want it to be considered alimony, and it's not. It could be something as literally a housing stipend. It can be like a child support payment. There are some that are a school payment or a thing like this, and they want to say, I was paying you alimony. It's not alimony. Okay. If that is stipulated in the divorce instrument, okay, in other words, the divorce decree states that it's some other type of payment, that means it is not alimony. If the spouses are legally separated under a decree of divorce or separate maintenance are not members of the same household. So, I don't even know quite how to explain that. Spouses are legally separated under or separate maintenance are not members of the same household, so they are legally separated. They cannot be living together is basically what it means. So they cannot be, and here's the problem with that. There are situations where they are required because of their living arrangements. They are dividing the house. So they can be legally separated and actually technically in the same household if the house is officially divided. So that's the only exception to that. There are houses that they've legally divided the house and made it two living spaces separate from each other. And this husband lives here and this wife lives here and they are legally separated. So yeah, that is, so they are not technically members of the same household anymore. It's the same house, just divided into two. It's kind of, they treat it almost like it's a duplex now. They've converted the house into a duplex. So payments are not required after death of the recipient spouse. In other words, it doesn't carry on. There are some that it goes and continues on to their estate. So it's a specified amount. So it says that you are supposed to be paying, you know, you got the rich guy who's got $10 million and you are to continue paying until you have paid $5 million. Well, she passed away last year. You're still paying. You haven't paid the full $5 million yet. Okay? That's not alimony. You only pay as long as the recipient spouse is alive. Okay? Payment is not treated as child support. That is a big one. A lot of people will have child support that they are supposed to be paying, and they assume it's alimony. It is not alimony. It is child support. Yeah, it's like, hey, I've been paying you. No, you've been paying the child support. You have not been paying your alimony. You have not paid alimony. Okay? So you've been paying your child support. These payments are deductible by the payer and includable in income by the recipient. So, in other words, he's had to pay them or she's had to pay them, because by the way, yes, guys can receive alimony from their wives depending upon what the income status is. I know that sounds weird. Most people are going, no, they can't. Yeah, they can.
Yeah, they can.
Yeah, they can.
What are we living in the 1950s? Come on, people.
I know. You would be amazed how many people do not believe that's even possible. But yes, it is. There are women who make a whole lot of money. So if this happens, the payments are deductible by the payer and includable in the income by the recipient. Now, payments are not alimony if any of the following are true. The payments are not included in a divorce or separation agreement. So in other words, you were being, you know, she has or he has extra income, and they're amicable in their divorce or however their separation, their divorce or whatever. And he really still cares about her, or she still really cares about him. Doesn't matter which way it goes, and wants to make sure that they're taken care of still. And sees that they're struggling, so what he does is he writes a check for her for a couple of $1,000s or whatever. Says, here, that is not alimony. That is a gift.
You're right.
Okay. That is, and I actually know of a guy who did that because he saw that she was struggling afterwards. He was not required to pay alimony. And he actually took out of his 401k, took out 20 grand and gave it to her. And wasn't required to. That was rare. But they had a really good relationship. The only reason they got a divorce is they just grew apart. They were living separate lives, really. So they never should have gotten divorced. They were really good together, kind of thing. So, payer and recipient spouse file a joint return with each other. If you're filing a joint return, guess what? You're not divorced. You know, it's like, okay, that's a pretty good guideline. If you're filing a joint return, you're not divorced. Okay, payment is not in cash. A non-cash property settlement. Spouse is part of a community income or to keep up the payer's property. If this is anything here, it's not in cash. It's whatever. You're giving them artwork. You're giving them whatever. You're helping them out. You're doing something for them. When it's saying not in cash, it can be a service. It can be a car. Okay. Hey, I gave you the car. I know you needed it. There was one that I know she needed a car that the guy actually needed a car and she had an extra one. She was actually married now and the guy was struggling and she had an older car from their original marriage that she got in the divorce and she gave it to her ex-husband just so he could get by. That was a good thing. I like it when they actually get along. That's actually kind of nice because it means the kids usually are actually decent too. So,
yeah.
Because then it's not such a bad thing. But that's one of the important things. Non-cash. Giving your spouse a car is a non-cash thing. Okay? No cash involved. Payment is designated in the instrument as not alimony. That's pretty much this exact same statement. If it says it's not alimony, guess what? It's not alimony.
Not alimony.
Payments the participants are members of the same household. Guys, if you're living together, you have to actually make the physical separation. So the only case I know where they did this, where it was actually considered they were divorced, they could not afford to sell the house. They were so underwater in the house that they could not afford to sell it. So what they did was they actually built a separation in the house and divided the house. Okay. So the house was actually physically separated into two houses, basically. So they had two separate living spaces. The bedrooms on one end, the bedrooms on the other end. They didn't have any common spaces. They set up their own kitchenette kind of thing in each side. No. So it worked as two basic living spaces. So that's the only way I've ever seen where that basically worked. And they were divorced because they just could not afford to sell the house because they were so upside down in the property. Payments are required after death of the recipient spouse. Guys, if they're dead and gone, you're not paying them alimony. Okay, it's kind of like Social Security benefits. If they're still getting Social Security benefits and they're already dead, no, somebody else is cashing the checks. That's a problem there. So,
Yep.
payments are required. Payment is treated as child support. Yes, if it says it is child support, it is child support. It is not alimony. These payments are neither deductible by the payer or includable in income by the recipient. So in other words, this is not a required expense. To be deductible, it has to be a required expense. Okay, that's the important thing for it to be deductible. It's not deductible. It's not a required expense. All right. Under Xander and Elena's separation agreement, Xander must make the mortgage payments on a home owned by Elena. If these payments also meet the other qualifications for alimony, Xander can deduct the mortgage payments he made as alimony paid on its return. And Elena must report them as alimony received, included with her taxable income. Yes, this is very true. Okay, so yes, this is true. Now, it does not have to come to her directly. It can come to the house mortgage payment. So if it's ordered, you know, this is true. So, expenses for a jointly owned home. If the instrument states that the taxpayer must pay expenses for a home they and their spouse own jointly, some expense payments may be considered alimony, depending on how the home is owned. This is important because in a lot of cases, if they owned a house together and they're not able to sell the house, sometimes one of them will stay in it and the other one will move out. Okay? And one of them will have to, possibly the one who moved out is still making payments on it, on expenses they own jointly. So, if you must pay the mortgage payments and your home is jointly owned, then you can deduct, and your spouse may include as alimony half of the total payments, and you can claim it as an itemized deduction. Real estate taxes and home insurance held as tenants in common. Now you have to understand how this is worded here. Tenants in common is a special type of living arrangement, or a special type of ownership, I should say, on real estate. It's tenants in common held as tenants by the entirety or in joint tenancy. These are all different forms of real estate ownership. Okay, that's very specific, because jointly owned is one thing, tenants in common is different. Okay, those are specific real estate terms in the form of ownership. It indicates a certain percentage owned. It indicates possession, and each one has its own set of rules. Okay, so it's very, very important on that. Half the total payments for tenants in common, none of the payments for held as tenants by the entirety. And you can claim as an itemized deductions all of the real estate taxes. That's because the real estate taxes are the responsibility of the person who actually pays them. Okay, so in other words, he can deduct them, whoever's actually paying them. If he must pay all of the real estate taxes, he gets to claim all of the real estate taxes, but not the homeowner's insurance. Okay, so this is a chart that you should definitely memorize. Okay, because
Where did you get it?
This is actually,
Right,
what's that? This is actually specifically out of, I'm trying to think where this one came out of. This is under the divorce other income section. Oh, look, I'll send you guys this one. Actually, I'll send it to you guys as soon as we're done here. I'll put it in the chat room so you guys can pull it up again.
Thanks.
Okay. So, and this is exactly what it's saying here. If Xander and Elena owned their home jointly, jointly, that's different. Remember, jointly is different than tenants in common and tenants in entirety. Okay. Jointly means they're husband and wife. They own everything together, 100% together. Tenants in common mean collectively they own the property, and they can have different ownership percentages. They can have different permission rights to the property, that sort of thing. Okay. Xander can only deduct half of the mortgage payments he paid as alimony on his tax return. because he actually gets ownership of the other one, technically still. So even though they are separate, he still owns half the house. That's why he's only can deduct half of it, because the other half is still his house. Okay? He doesn't get to deduct his half of the mortgage payments. He gets to only deduct her half of the mortgage payments. Elena would report half of the payment amounts as alimony she received because she's getting that from her ex. Okay, payments not considered as alimony. Not all spousal payments included in a divorce or separation instrument are considered alimony. The following payments are not considered alimony: child support, non-cash property sales. What was that, Beth? Okay.
Oh, nothing. I'm outside.
Oh, okay. Non-cash property settlement, payment for the upkeep of the payer's property, use of the payer's property, payments that are part of a community income as designated in a community property state. These are pretty simple, okay? Those are obviously not part of alimony, okay? Child support, if you're keeping up the payer's property, it's not part of alimony. Okay. If Xander owned the home by himself, but Elena lived there under the rules of the separation agreement, Xander's mortgage payments would not be alimony. Okay? Because she's only living there because he owned the home by himself. He still has the whole value of the house is his. So it's not going to her. It's part of the separation agreement. Once the house is divided, that would be different. So Xander could not deduct the payments on his return, and Elena would not report the money as alimony. Because Xander owns the home. She is just living in it under the separation agreement. See, remember, this is not a divorce decree yet. This is just simply a separation agreement. So they have not divided the house. Okay. Candy Martin received $1,200 per month in alimony from her former spouse, Josh. The payments meet all of the qualifications to be considered alimony. Candy, as the recipient, would report $14,400, 12 times the $1,200, as income on her Schedule A, line 11. Okay. Josh, as the payer, would deduct the same amount on his Schedule 1, line 31, as adjustments to income. That makes sense. Okay. He paid it out. He was required to pay it out. It's not income that he was able to use. He must include Candy's Social Security number on line 31B as shown. It's very simple. He has to indicate who it was that the money went to. Reporting alimony. If a taxpayer pays alimony to more than one person, enter the total amount of payments for all recipients on the taxpayer Schedule 1, line 31A. Now that is a pain. Think about it. If you were married like 4 times, you know, I mean, you could be paying out alimony to a whole bunch of things. You know, it's like there was a joke about what series of Bosch. I saw that on Prime Video, on Amazon Prime. It was one of those series on there, and he was a police detective who was retiring. And he goes, "Yep, I got 3 wives I'm paying alimony to." He goes, "I just wish I could get one of them married off at least." You know, he says, because right now I'm paying alimony to 3 ex-wives. I'm sitting there going, how do you pay alimony to 3 ex-wives? How do you
Being married
survive?
just doesn't seem to pay off nowadays.
How do you pay alimony to 3 ex-wives?
Very carefully.
You know,
You live in your car.
there you go.
God forbid you pay child support as well.
Yeah, there you go. Enter the Social Security of only one of the recipients on line 31, then attach a statement listing the Social Security and amount paid to each of the other recipients. Who was it? Was it Britney Spears, one of them, who was married for like 19 days?
I think
I
most
can't-
celebrities have had marriages lasting hours.
You know, I mean, I envision that. You know, it's the one she went down to Vegas, got married, and got a divorce 19
Yeah.
days later or something. I
Well,
can't
hers
remember
got
one.
annulled. It was annulled, so it technically never existed.
Oh, I'm just like, I'm sitting there going, how do you do that? I mean, when you think about it, it's kind of like, so you're paying alimony on that one, then you got another one here. Man, within a year, if you're doing an average 19 days, you could have 12 spouses more or less, you know, a year, something like that, 12 X's in a year. Man, you could be paying alimony to God knows how many people. You know, you could make this an occupation.
Oh, no.
You know, how do you keep up with that? So, how many alimony checks do you owe? You don't want to know. You know, it's like, so.
Well, if they can't pay them, it's in it'll be in arrears forever.
Yeah. Well, I don't know. I just I never want to get a divorce. I love my wife. Okay, she's everything in the world to me. You know, I have no desire to get a divorce. So I've had one wife. I'd like to keep it that way. So
Sounds good to me.
yeah. So the alimony recipient is required to give their social security number to the payer. If they do not, now this was really cool. If they do not, the recipient may have to pay a $50 penalty.
Hmm.
How would you ever get married and not at least know the social security number of your husband or wife?
If it
Some of
lasted
them
19
don't.
hours.
The last night, I suppose that's true.
A lot of the
know,
guys don't know.
I know my wife's social security number. I know.
Well, I know, but a lot of the guys that have been married like 4 or 5 years or something, 10, they don't know.
I guess. Like I said.
Sometimes they don't even know their birth date.
Yep.
Well, I mean, it's kind of dumb because when I mean, I had my mom's and my stepdad's written down somewhere. So,
I've got the file with our marriage certificate, all of her immigration stuff, all of our passports. I've got, you know, we've got a copy of it here, all the official copies. I got them locked in a safe here in case we need an extra copy of it, you know, birth certificates, school records. You know, I know her social security number. I know mine. I know her birth date. I know her anniversary. I'm like, the only time I
well,
get messed up is I can't remember all of my nephews and nieces' birthdays. I do know them more or less. I just keep okay, which one's coming up here, you know, kind of thing. I usually know when they're coming up. I just don't always remember the specific
that's how
order.
Dennis is. He just
Yeah.
won't know what date.
Yeah. But I mean, honestly, it's like, come on. I will never forget August 19th. If I ever forget August 19th, someone shoot me. That's my baby's birthday, you know?
Uh-huh.
And it's like, you know, but I don't know. I'm just trying to understand that one. Because if you're so close to a person, you're willing to get married to them, God, I'd hope you'd actually know some stuff about them.
And some of them, Pam's right, some of them come in and they don't know their wife's birth date. It's just ridiculous.
I know her birthday. I know, you know, it's like,
Oh, I fill out applications for Dennis and just have him sign them because I know everything that needs to go on there.
okay, let's put it this way. Well, actually, it's not fair, I guess, considering his birthday is the day before mine. So I do know my stepson, who was actually, you know, I've never met in real life because he died before. You know, he died when he was a year and a half.
Uh-uh.
And so he died before I ever met him, but I know his date of birth and all because, well, his birthday is February 17th and mine's February 18th, so I'd never forget it, I suppose. But, you know, when you think like that, I mean, who does that, you know? But I don't know. You get a penalty if you don't put it on there. So honestly, put it on. Okay. Here's the next kind of income. Honestly, if you're not paying child support, you need help. You're supposed to be taking care of your kids. You know, find a way. But child support payments are not taxable to start. That's the most important thing. Child support payments are not taxable. Payments are treated as child support when specifically designated as such under a divorce or separation agreement. Contingency events will usually cease child support payments when specifically related to an related to or associated with a child. So in other words, if something happens or things, there are situations where the child support will be ended or whatever when certain things occur. It's child support. Take care of your kids. So, under the terms of the divorce agreement, Leanne made a payment of $3,000 directly to the college for her ex-spouse's tuition. Leanne can report which of the following on her tax return. Now, she made a payment of $3,000 directly to the college for her ex-spouse's tuition. Now, this was ordered by her divorce agreement. So, it's a check she wrote, whatever. So, it's paid the right way. What would that be considered? It's tuition. It's not a mortgage.
It was ordered,
Uh-huh.
then she has a deduction as alimony paid.
Okay, but how much? I see a $3,000 one, a $1,500 one, or $3,000 as alimony income.
Not income.
It's not income, so we can eliminate that. We know it's not a
Is it-
zero deduction because it was ordered.
3,000 deductible as alimony paid.
Okay, so what do you think? It's the 3,000 or the 1,500?
3,000. Why would it be
3,000. Just checking. Because on a house on a mortgage payment, remember, you still have half ownership.
Half, yeah.
So
Oh,
okay, so their divorce instrument requires Tony to pay Florence $5,000 per year for spousal support. She said that amount, he paid that amount, but also gave Florence an additional $2,000 because she fell on hard times. How much must Florence report as alimony income on her tax return, and how much can Tony deduct as an adjustment to income on his taxes, respectively? So, $5,000 for spousal support. He paid that, but also gave Florence an additional $2,000 because she fell on hard times. So, how much do you think he can give her?
5 and 5.
5 and 5. What do you think, Pam?
5 and 5.
Beth, are you there?
I think she's went to get her kids.
I
She's
think so too.
walking.
I think so too. It's 5 and 5. The $2,000 is a very nice gesture and it's very important. And it's good that he did it. That's what it should be. But it's 5 and 5.
Yep.
Okay. Jose paid $3,600 of alimony and $6,000 of child support to his ex-spouse Gina as required under their divorce instrument. Use this information to answer the questions on the following slides. What amount must Gina include on her tax return? So she's got what, 9,600 there?
36 alimony
So
income.
how much?
36.
36, thank you. I was trying to mislead you. Jose paid that, and on which line of Gina's 1040 is her alimony entered?
Schedule 1, line 11.
Ooh, she is so good. How did you get that one so fast?
I read it 20 minutes ago.
All right.
But if you ask me tomorrow, I'll forget.
You'll have completely forgot I got it. What amount can Jose deduct as an adjustment to income on his tax return? So she can claim $3,600. How much can he deduct?
3,600.
$3,600. So Jose paid $3,600, and on which line of Jose's 1040 is his alimony deduction entered?
Was it that
Dun
schedule
dun
one?
dun dun dun
Line
dun dun
31.
dun
Yeah.
dun dun dun. What was that? Jeopardy? Dun, 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 dun.
And we both write down line 31A.
Thank you. Line 31A. All right. Miscellaneous income. It is income that basically comes from the miscellaneous sources. Makes sense, doesn't it? All right. Taxpayers can receive other types of income, such as life insurance proceeds, public assistance benefits, which makes no sense because you can get taxed on public assistance benefits.
No.
Figure that out. Huh? Unemployment is a public assistance benefit. You get taxed
Okay.
on it. So tell me no. Yeah, what? Huh?
I know.
Workers' compensation. Okay. Yeah, you can get taxed on
Sometimes.
that. Gambling winnings. Yep. Hobby income. Hobby income. Prizes. Canceled debts. Other miscellaneous income. Okay, if this is considered miscellaneous, then how do you get other miscellaneous? Isn't that kind of like redundant?
Uh-huh.
It's like under redundant, it says see redundant. Oh no. Okay, life insurance proceeds paid directly to the taxpayer because of the death of an insured person are not taxable unless the policy was turned over to the taxpayer for a price. What does that mean? Any idea? Life insurance proceeds paid directly to the taxpayer because of the death of an insured person are not taxable unless the policy was turned over to the taxpayer for a price.
How could that be turned over to a taxpayer for a price?
What's a life insurance policy?
They died.
What is a life insurance policy?
Money.
So is it because they didn't die? They bought it back?
No. Keep going. No. What is a life insurance policy?
Pays
Are we
your
talking about-
beneficiaries when you die.
But no, you still haven't figured it out yet. What is a life insurance policy?
I guess I don't know where you're going with it.
A life insurance policy is a financial instrument. It is a contract. So
Yeah.
what can we do with it? So what can you do with a financial contract?
You can sell it.
Break a contract?
Thank you. Somebody said it.
Yeah, that's true.
Sell it.
You can sell it.
And you can borrow off of it.
You can
too.
borrow off of it. You can do all kinds of things. You do not need to be the original person. You do not even need to be. I can insure somebody who I'm not related to. I don't even need to insure myself. Okay. So what happens? I can sell it. It has value.
Yeah, you can go up there.
Okay. So what happens is, if I bought this life insurance policy, guess what? It becomes taxable to me. Why is that?
It's income.
It's income. Thank you. She got it. Thank you, Beth. That was awesome. If I bought the policy and now I'm being paid on it, it was an investment to me. If I've been paying into it with money that I had already paid taxes on, what's it considered?
Oh, I know this. Like a Roth, kind of, sort of.
She got it almost. Keep going.
It's post-tax.
Post-tax. She got it. Thank you. Pam wins a cookie. It is
Yay.
post-tax.
There's cookies involved?
Yeah, we got cookies. They're over to start. It is a post-tax payment because what happens is
Virtual cookie.
we have virtual cookies, I think. So I'm paying for it with post-tax dollars. I've already paid the tax on them. So it's not taxable to me, right? If it was with pre-tax dollars, okay, like an IRA, then it would be taxable when it gets paid out. But if I actually paid a price for it, I'm doing it like an investment. If I bought this off of somebody, it's not basically, I'm doing this as an investment. I'm putting money into it to get this out, right? So it's no longer being treated the same way as it originally was.
Oh, shoot, she's crossing.
So I'm buying a financial instrument. I'm buying somebody's contract.
With their interest and all.
With their interest and all. So You guys know what a reverse mortgage is?
Yeah.
You know what a reverse mortgage is?
Yep.
Yep.
Okay. Basically, it's saying that I'm going to sell you my house so that when I die, you get it.
No.
Okay.
Copper, go back.
But I'm going to get money out of it right now, and you're going to pay me this money. But when I die, then you get the house. I get the money now. You get the house when I die. Okay.
So is that money taxable?
Is it income?
Sounds like it to me.
It's income. So that is considered income. So
Clotheslining.
Okay, let me get this straight. A person buys, let's say you buy your mom's house, and she still gets to live there until she dies, and then you get the house.
Yep.
You paid off, let's say you paid the house, you bought it. It's mom gets money from it. That's taxable?
Your
mom.
mom, to your
perfectly
mom,
in that
yeah.
perfect timing. I was like, whoa.
To your mom, that's income to her.
Okay.
It's capital gains on the house. You've just bought the house, technically.
Right. But it's not taxable to me because I bought the house.
Because you
right?
bought the house, correct.
Okay.
It's taxable to her.
Okay.
Not to, so.
Yeah, that sounds normal though.
But with this, think about it. It's not taxable unless you bought the policy, because you can buy just about anything. It's like I said, even after you die, you can buy and sell stuff. So here's the thing too. You can buy and sell your life insurance policy. Okay, when they say you're cashing in your life insurance policy, what are you doing? Selling it back to the company.
Yeah.
Okay, so with this, what are you doing? You're just selling it over to somebody else for a discounted rate.
Mm-hmm.
Okay, so earnings received when the proceeds are invested are taxable. So when you are getting it, okay, so if you are getting paid money for it, so they are paying you money, and you give them the insurance policy, what happens? Somebody pays you money for the insurance policy, what happens?
Taxable.
It's taxable. Sucks to see that, isn't it? Because that's taxable.
Mm-hmm.
So you're really losing on that one. They're going to tax you on the money you made, and they're going to get taxed on the money that comes to them. You just went from a tax-free instrument to a double tax instrument. Not a good way. Not a good way to do it. Okay, because remember, there is such thing as double taxation. Most people do not realize that, but this mainly happens in the business world. A C corporation gets taxed all the time. Let's say I own a corporation that's a C corp. They get taxed on the money that's left, right? So they actually get taxed on it. If it's an S corp, it passes through, but we're not going to get into that. But a C corp gets taxed on the money they have left. So now I'm the person who owns the C corp. That money now comes to me. Guess what? I get taxed on the money that comes to me. I got taxed on the business level, that the business got taxed on it, and I get taxed on the money that comes to me. I just got double taxed on my money, didn't I?
Well, that's what I was wondering, because my stepbrother decided that he's going to buy my dad and my stepmom's house.
Uh-huh.
And he's going to pay cash for it. And so they're going to get the money in their bank, and he's going to get the house, but they're going to live in the house till they die or have to go to a home. And then he'll have the house. To me, that's kind of silly.
That's really stupid, because what happens when they die?
When they die, it gets split between the 7 of us.
Yeah, but what's going to happen basically when they... Did I go backwards?
I don't know.
Probate.
It's going to go into probate.
They have a will.
But here's the point.
Trust.
they can indicate who it's going to go to, and they can put it in a trust. But here is the thing. There it went. There's what I was looking for. He's going to inherit it anyways. Do you pay inheritance tax on a home and that sort of thing typically? Not really.
Well, there'll be a capital gain, right?
It'll be a capital gain, but is it going to be a whole lot more tax to them, and then he's going to have to get it anyways?
Yeah, that's what I'm thinking. They're going to pay capital gains on it, and then we're going to pay capital gains.
So why doesn't he just sign a quit claim? They sign a quit claim deed over to him, never transfer the name over. He's got the quit claim deed on file, and he just give them the funds, gift it to them. There's a whole bunch of better ways to transfer that money.
I know, but he won't listen to anybody, and my dad's being bullied, so whatever. I mean, we're washing our hands of it. My brother,
I mean, that's a stupid way to do it.
Yeah, that's what I said, but no one will listen.
Because what's going to happen to them? How much is he going to pay him for the house?
Well, he's whatever the market value is right now.
How much do they owe on it?
They
own it outright?
No, because they have a reverse mortgage.
Wait a minute.
I don't know how much it is.
They have a reverse mortgage?
Yeah.
And they can't sell the house anyways.
Well, if they pay off the reverse mortgage, they can.
Yeah, they'd have to pay off the full value of the reverse mortgage.
So that's what my stepbrother will do. He'll pay off the reverse mortgage and give them what's left over. The value up to the value of the house.
Oh, that's going to turn into a great big one.
Oh, I know.
That'll be interesting.
You know, he's a real estate person, and he thinks he knows everything.
That will be an interesting situation.
Oh, well, yeah, that's not the only part interesting. He and his girlfriend have taken me and my oldest stepbrother off the executor part and put themselves and my brother John on as executor now. And my dad just signed stuff, you know, he's old.
Well, so, you can put that into probate just with that. He's old, so.
Well, then they did a psych
test.
They had a psych test and had somebody sign a thing that he was in his right mind.
Well, that's interesting. So anyways.
I know. Anyway.
I'm sorry.
I knew it was stupid, so.
Yeah.
I just wanted to make sure I was right.
Yeah, that's going to basically end up with so much taxation and
double taxation, yeah.
So, this is really interesting. Public assistance benefits. Some cases are taxable. Other cases are not taxable. So, taxable is welfare payments that are compensation for services that are obtained fraudulently. Okay? In other words, if you lied about the need for them, they're taxable. You also would typically have to pay them. Unemployment assistance payments are taxable. Now, non-taxable is benefit payments from a public welfare fund. Okay, based on need. If you actually need it and you can't pay, guess what? They don't typically tax you on it. But, like I said, if then it's later found that you were not in need of it, guess what? You do have to pay taxes on it then. Payments from a state fund for the victim of a crime, if the payments are welfare payments. Qualified disaster relief payments. Of course, these should not be taxable. Post-disaster grants made under the Disaster Relief and Emergency Assistance Act. In other words, the rebuilding of houses and that sort of thing that you needed, they don't tax you on it. If it's to help you rebuild your home and things like this, they don't tax you on that specifically. Okay? That's very important that you understand that there are actually two types of public assistance that are taxable, and that's the welfare payments that are services that are obtained fraudulently, and unemployment assistance, because most people think that unemployment is not supposed to be taxed. You would not believe how many people believe that it is not supposed to be taxed. Why would you tax unemployment? I was unemployed. Because it's direct payment to you. It's direct income for, it's supposed to be a substitute for your work. Would you be taxed on your work payment? Yes. So why would you not be taxed on this income? All right. Workers' compensation. Amounts received as workers' compensation are not taxable if paid to the worker under a Workers' Compensation Act or statute. Now, this is really important. It means if you got hurt on the job and it was actually a workers' compensation situation, they realized that you had no ability to work. All right? That you are not eligible to work. This is not like you were looking for work or whatever, you know, that sort of thing. You are not eligible to work. This is like a disability based upon an accident you received at work. So as a result, it's not considered taxable. And that's important to understand because I know this has been tested on. At least I know that people have said that this has been on the test. Workers' comp is not taxable. Okay, amounts received as a beneficiary of someone else's workers' compensation are not taxable. So that one's important too. So if you are a beneficiary of someone else's workers' compensation, so when would you be a beneficiary of someone else's workman's compensation?
Someone passed away?
Someone passed away, something happened, somebody died on the job. Workers' comp comes in, guess what? How about if they are not eligible to do anything anymore? They're totally disabled or something happened. The workers' comp comes in, it comes into their guardian. You're their beneficiary, you're their child, who knows? Okay? It may not be coming directly to them. So it's coming as income to you. So as a result, it's not taxable even to the beneficiary. So retirement plan benefits received based on age, length of service, or prior contributions are taxable. So these are the retirement plans like your pension plans. These are taxable. All right? And that's really important to know. Workers' comp is not taxable, even to the beneficiary. Retirement plans for length of service, you know, if you work for 20 years, you get this retirement plan. If you've been, you know, if you're age 65, you get this, okay? They are taxable. Okay, gambling winnings. This one's always fun. Now, this includes, by the way, stuff like the lotteries, which nobody ever keeps track of. Raffles, which nobody ever keeps track of. The scratch and wins, which nobody ever keeps track of. Because the scratch and wins do count, by the way. So you win that $25 here, the $75 here, the whatever here, and you get the scratch and wins. And if you total them up, guess what? They count, but they never get counted.
They could be as low as $1 too.
Uh-huh.
I purposely didn't turn mine in because, like, I don't want to clean that.
There you go. But gambling winnings need to be reported, and they come on a form W2G for certain ones. Again, this is from the casinos and that sort of thing if you have a large enough amount. The W2G has withholdings usually. You can see here what their requirements are. 1,500 or greater in winnings from Keno games. Okay, that's pretty straightforward. 1,200 or greater in winnings from bingo games or slot machines. Now, $1,200 is the general rule. They will actually, they can do it below that amount. Okay, but they usually do it at $1,200. That's considered their jackpot level, but they can do it down to as low as 500. And the main reason they do that, why would they possibly do it to somebody for a lesser amount? What do you have at a casino? Lots of people. No, lots of people.
Oh, yeah.
Okay. Where are the people from?
All over.
Define all over.
Other states?
Nope.
Other states, other countries.
Other countries. Other countries. People who are here as visitors.
Don't they have gambling in other countries?
Oh, yeah, they do.
In
They have
South
it
Korea, it's
all.
illegal.
Okay.
They like to come here.
Actually, South Korea is about to open one of the largest casinos in the entire world.
But it's illegal for the locals. They're doing it for the
tourists.
Yeah. As a citizen,
the Mohegan Sun is the one actually opening it. So what ends up happening is when you have people who have a passport, what has to be filed? When you have foreign person.
That declaration thing?
It's called a 1042. The form 1042 is for foreign entities which are declared. What happens if they don't have their passport?
They're not going home?
If they're in the casino and they don't have their passport, what has to happen? Do we trust them?
Some identification,
No,
right?
I don't. No, I don't.
No?
They're a foreign person. Their signature counts,
I've
but
never
what
set
has
foot
to
in a
happen?
casino. I don't know.
Would they not get to get the money until they brought their passport in?
They can have some form of ID that just shows who they claim to be. What happens if you claim to be a non-U.S. citizen and they are going to withhold how much?
Oh, they're going to take your taxes now.
There you go. See, she starts to get it. The 1042.
I like that.
The 1042, they withhold 20% because you've identified who you are. You have a passport. The 1042, they withhold 20%. Guess what happens when you can't officially identify yourself? What do?
Hold more?
They withhold more. They withhold 30%. They hold it on a 1042S. Why is it an S?
30%, you said?
I withhold 30%. And why is that?
Because if they don't, they won't ever get it.
Because it's a signature.
Oh.
You're releasing the amount based upon their signature, saying that it's an affidavit saying that they are saying who they are, that their signature is saying who they are. So that's why instead of 20%, they withhold 30%. That's a 1042S. So on a 1042, that's if they've identified themselves, they can withhold 20%. And if it's a 1042S, they have not officially identified themselves. You're releasing their funds, but withholding 30% on their signature. So if it has $5,000 or greater in winnings from a poker tournament, okay, or buy-in costs. What's a buy-in cost?
Would you buy in to play the poker game? Everybody has to put in so much, I think. No?
There you go. Yep, that's exactly right. Blackjack tournaments have a buy-in cost. Poker tournaments have a buy-in cost, that sort of thing. Okay? Winnings of $600 or greater, not from Keno, bingo, slot machines, and poker tournaments. You will notice something. Those amounts, that's why I said $600 is so important. Because if you notice, Keno is not a high-end game. Bingo is not a high-end game. Nobody actually plays bingo typically at the casino anymore. Slot machines are usually, if it's paying out, they do the $1,200. you'll notice that none of the table games are included in there because the poker tournaments, notice it says poker tournaments, doesn't say the normal poker play. Okay? Poker tournaments. It specifically is worded that way, by the way, because it doesn't say the table games. It does not include baccarat, blackjack, roulette, craps, any of the actual table games. Any amount can be withheld there. Any amount of $600 or greater from any of those other games is withholdable. How hard is it to win $600 when the bet's $500? Any idea when the bet is
No,
the
if the
max bet is
bet's
500?
500?
The max bet that the ALNA is $500.
It's not that
Two
hard to win
hands.
then.
Two hands.
Yeah.
You can be at $1,000 in winnings. Two hands. You can be over this limit. They can withhold. So if you were doing a max bet, you can be over the amount. So that's why it's very important to pay attention to the people playing.
Lose money fast.
Oh yeah, you can win money fast, you can lose money fast. But that's very important here because what about the slot machines? Why do they have it set at $1,200? Because I know that most people are just going to be betting how much on the slot machines.
Couple
Are you
bucks.
betting $500 every time you pull that lever on the slot machine?
No.
No, you're betting usually at the most maybe $20. Okay. How about the Keno games? $1,500 or greater. How much is the most you're betting on a Keno game usually? Usually about $2 or $3, maybe 10. Okay. The poker tournaments. To get into the poker tournament, that's why it says poker tournaments. $5,000 or more and greater winnings because people play in the poker tournaments all the time and win just little amounts. They don't want to have to report it all the time. So the only ones that matter are the ones where there's real money to be made and lost. And that's the table games. Okay. They actually make the casino makes most money on the slot machines, but that's because people play all those games all the time. But on the tables, that's where you can actually win if you know the most, where you can win the greatest amount of money. So that's why it has the lowest level for reporting, $600. Okay. So also, why is that really, really important for the slot machines versus the table games? What's the difference between a slot machine and a table game?
Working with somebody versus by yourself?
Right.
No.
How much you have to start out with?
How do you play a table game and how do you play a slot machine?
I don't play tables, so I don't know.
No, I'm not talking about that. How do you play a table game? Just basic.
Walk up to a table and start playing?
Thank you. What did you just say? Now describe it.
Walk up? I've never been to a casino.
Walk up to a table, and what do? You lay cash on the table.
Tell the person.
You lay cash on the table, and what do you get back?
Chips or something.
Thank you. What are the chips?
They're worth monetary amounts.
They are actually considered legal currency in that casino.
Okay.
Oh.
They are legal currency in that casino. They are valued at anywhere up to, they actually have $5,000 chips at the casino.
Whew.
They don't even have $5,000 bills in U.S. currency.
No.
But they have $5,000 chips at the casino. Actually, they have some $10,000 chips too. We have a few. They're plate chips, $10,000 plates. So they're much harder to carry and not be seen. But they have $5,000 chips. So what happens when you have a chip that is considered legal currency within that casino? I walk with it. Now, in legal terms, I just gave somebody $5,000, right?
Mm-hmm.
What did they give me back? $5,000 equivalent in chips, right?
Right.
Now I walk over to the cashier. What's $5,000 in chips?
$5,000 in money.
In US dollars now. Is that reportable? It's below the
Yep.
$10,000 daily limit, isn't it?
Says 5,000 or greater if you're playing poker tournament.
Oh, I'm not talking about your winnings here, because they
Oh.
track the winnings. I'm talking about for reporting the IRS daily monetary transaction. I am
Then
a
I
drug.
guess not.
I am a drug dealer.
Aha, you are?
I am a drug dealer. I take $5,000 in illegal cash, go
Oh,
up to the casino, lay $5,000 in illegal cash
laundering.
onto a table, get $5,000 in coin, which is now legal currency in chips, walk over to the cashier, cash it out. What have I just done?
Money laundering.
Thank you. Is that now legal currency? I now have the video surveillance showing that I just cashed in $5,000 in chips.
Yeah.
Guess what I now have in my hand? $5,000 in legal U.S. currency.
That's clean.
It is clean.
Yep.
Did I have
Maybe
any gain on the game? Did I have any gain?
Nope.
What did I buy in for?
5,000.
What did I pay out for the end of the day?
5,000.
5,000.
Is it reported?
Nope.
What is my daily gain?
Zip.
Zip.
Oh, yeah.
So guess what? I just laundered $5,000 in U.S. currency. Really easy to do.
Wow.
That's why it's so monitored, because it's much easier than any other way. Why do you think casinos are watched so closely?
I don't know.
Not watched. It's not watched by for its. If it wasn't for the money laundering and all that, it would be the casino wouldn't care. They would just be watching for cheats. Okay, that's one thing, a cheat. But money laundering and illegal activities, that's why it's important. That's why they make them report it so heavily. That's why they have to withhold these amounts. This is what you guys need to know, because that's why they're taxable. Because what are you taxed on? What's it say here?
What you win minus what you wagered.
There you go. It's winning. Not much you wagered. It's winning. So what do you have to track in the casino?
Your winnings and your losses.
How much you bought in for, and how much you cashed out for. And if you have any jackpots, that's why specifically they have these jackpot amounts. Because did they track the person? Are they going to be able to track Bob, who just won $50 for every Bob there who just won $50? $50. It's not even possible.
No.
Okay. He puts the $50 in his pocket. Oh well. But if they have a winning of $600 or greater, they have to track it. Now, how do you track it when you're playing a table game or playing a table game bet of say $1,000 to $500 hands?
You got to turn in your chips
at the end of the day. But they need to track what do they have to do before each deal. What do you think they would have to do before every deal when a player has black chips out on the table?
Record it somehow?
They have to report it they have to call it out to the pit boss so that they can call it down to surveillance and make sure it's recorded that there's black chips in play. Those are $100 chips.
Okay.
So it can be recorded. So they can determine how much that player is actually winning so that they don't do the illegal thing. So that we can track this. Because the jackpots are easy to win, to notice, because you can stop when somebody has a full house or whatever it may be in a poker hand or something like that. or they're playing Pai Gow and they have a winning hand at Pai Gow, or they're playing blackjack and they've got 2 Queen of Hearts on the bonus, so they can do that. They're playing $1,000. You'd be amazed when they're playing a $20 chip on the 30-1, or they're playing a $100 chip on the 30-1, and they hit it. I've seen them on the baccarat table play a $100 chip on the 30-1 and hit it. You know what the payout is? Do the math on 30-1 on a $100 chip.
30,000.
$3,000.
Oh.
$3,000 in one thing. $3,000 in one payout. Guess what that falls under? That's a little over the $600 limit.
Yeah.
That stops the game, and they have to report it, and they have to pay pull the taxes out of it. So that's really important, especially at the blackjack tables, and the slot machines. Okay, so that's really important, these winnings, because if you get paid out, what's the other thing that you win at the casino?
Prizes.
What's the big thing that you win at the casino? It's listed up there, right up at the top.
What?
It's the second thing listed there. It's
including.
The next row down. The casino usually gives out one a month.
Oh yeah, cars or benefits or hotel rooms or.
There you go.
Non-cash.
They have the comps.
Yeah.
They give out hotel rooms, dinners. Do you know how
How do you win those?
Amount of play. They track how much you play with your gamer's card. What do you think that card's for?
I didn't even know they had a gamer's card. I've never been to a casino.
Tracks how much
Not
they
my
play.
goal in life.
Oh man, casinos are the most fun in the world. I was there yesterday.
I've had kids for a long time. I don't get out.
So, actually, kids are allowed at LNA. They can go in. There's lots of restaurants and things to do up there for the kids. But anyways, they give out the comps all the time, which are the cash cards, the dinners, the cash plays, the equivalent cash plays. They usually give out a car a month, something like that, or a car every other month to a winner. They give out the Players Club stuff so that every time you go up there, they give you, if you're returning, they give you gifts all the time. Be it.
So do those end up on the W-2Gs also, or do those end up on 1099s?
They end up on a 1099. You get that at the end of the year. Boy, do I hear about when they come out.
Even if you win a car, you get that at the end of the year also?
Oh, yeah.
But not when you win it from Oprah?
Oh, when you win it, when you win the car, you get it at the time, but you get the actual report form at the end of the year, no matter what.
Oh, okay.
Taxes withheld at the time.
Earlier.
Taxes withheld at the time. At the time of the occurrence. You get the reporting at the end of the year. You get it January. You get the form which says you won this amount from us. This is what we have as a recorded amount from you, and it's on a W-2G is what it's on.
So then if you win it from the casino, they demand payment before you take the car, or do they put you on a payment plan, or? They
demand payment before you get a cash equivalent or the car, which at that point you have to pay the tax on.
Okay.
Cash equivalent, they'll just take the tax out of the cash equivalent. Or if you really want the car, then like the Corvette was really nice. It's a new Corvette. If you
Can you
want
just
it,
take
you
the cash equivalent and then go buy a car?
yeah, if you want to. But you can't get. You still get. You'd have to have. You still have to pay sales tax on the new one then. So
Sales tax in Oregon?
you can't buy one in Oregon and bring it up to Washington.
Well, I live in Oregon. I wouldn't take it up to Washington.
Mm-hmm. So, but that's one of the things that will happen is you will get the cash equivalent and go use it for something else, or buy a different type of car. So you got to think about those things. Is it worth not taking? It's kind of like if you hit the lottery. Has a lottery winner ever taken out the actual payment over time recently? Some of the first lottery winners thought it would be really cool to get payments for the next 20 years.
I still hear people saying that, though, and I'm like, no.
They get those payments over 20 years. You'd have to be absolutely insane to get those payments over 20 years. I can invest the amount better than I would assume getting it, But think about it. You get those payments over 20 years or the cash equivalent to half of it. You get about 60%. 40% goes to taxes. I don't know how they figure that one out because I could do better in taxes than that. Because first thing I would do is I would never cash it in under my name. I would cash it in under a business.
A business?
Uh-huh.
Can you do that?
Why not?
Well, that's the lottery, they give you. I don't get it.
Because most people are not smart enough to do it that way. They just.
Well, then you better tell us because I'm going to win the lottery someday. When I buy a ticket.
And you're going to remember that we are all your friends.
But I have to go buy a ticket first. I know.
The first thing I would do is I would actually just make a Xerox, sign the back of the ticket, fill out the back, make a copy of it, and stick it in a bank vault somewhere without telling anyone which bank I had put it in. Then I would go contact an attorney. I would not have any public appearances about it and contacted an attorney who would actually go in and represent me.
Okay.
Yeah, I don't need the public crap that would be associated with it. Because you're not required to have your face on TV.
Right.
So I would never want to have that.
So you don't have to tell who you are.
Why?
Well, I thought you had to tell them to get the money.
Not if you have
And
a
sometimes
representative.
they do it anyway.
Oh yeah, they'll do everything they can to find out who you are.
Yeah, you don't have to have it public.
Nope, you don't have to have it public. You just have to report who's picking it up. So I would have an attorney picking it up for me, my representative who...
The business thing. You can...
Mm-hmm.
As a business?
Yep. Why? Why not? It's my asset. I can have me as myself. You know, most people do not understand business entities. The first thing I would do is I have a friend that, believe it or not, she goes around that her name is Celia. Her name is not Celia. That's her business name.
Mm-hmm.
Okay? She signs her name as Celia, and she signs it as a representative of the company. Okay? She named her company based upon the name of a person, which is actually an entity.
I was just unaware that business entities could win the lottery.
Yeah, why not?
Well, why?
Because then it's actually
Not an
considered...
actual human.
Yes, you are.
A
You have
business
no
entity.
idea. You have no idea how a business entity works, do you?
No, thank you for pointing that out.
No. I'm just, dear. What I'm saying is this: businesses.
We have a business entity. My husband is.
What I'm saying is
business.
most people do not understand that a business, once it's created, is a life of its own. It's actually a living, breathing organism. It has its own life. Once it's
tangible, living, breathing organism.
No, it's not. No, it's not. I can go right down. Is Nike an intangible, living, breathing organism? I can walk down
You
to
can
Nike.
touch the buildings.
Yeah, exactly. I just told you. What happens when? What happens? Where's Phil Knight? Is Phil Knight
in the building that the entity owns?
Phil Knight is not even in the building. Phil Knight has nothing to do with Nike anymore. It grows on its own. Once a business is created, it is its own life. It has its own everything. And most people don't understand that. It has its own existence entirely.
Well, what's the next thing here? I want to pass this test.
So, all right. So, these are how we report our gambling winnings. This is a W2G. It's really simple. Gross winnings, right there at the top. This shows how much you made, and the federal withholdings are in box 4. It says the type of winnings based upon what you had, what was withheld. It's not complicated. The only thing that's bad is the fact that most people don't include it in their income. They don't even think about it until after the fact that you just filed your taxes and everything, and then it comes to you, and they don't want to include it. Why don't you want to include it? Because usually it'll screw up your tax return. Because what are these winnings usually? Regular income. Ordinary income gets taxed at the highest amount. Okay. Hobby income. What is considered hobby income?
Not in it to make a profit.
Exactly. You were in it because you were taking pictures. You put a couple of them online, and guess what? They sold. You were making a couple of signs in a craft fair and sold them off. They're not considered your primary income.
Mostly the intent.
Mm-hmm. That's correct. They're not your primary income. They're not something that you not have a dedicated amount. Your intent was not to actually make money at it. It's something you do as a part-time basis. Okay. And it's reported on the Schedule 1, line 21. So it's pretty much it's a not-for-profit activity. So in other words, you really weren't trying to do it. You just ended up with some extra income from it. Okay. Lots of people do it. It's actually a lot of fun. Craft fairs usually in a lot of cases end up as your hobby income. Something you do on weekends. Okay. Actually, a lot of them start out as a hobby income and grow into their regular income. So that's actually one thing that's really important about a hobby income. It can actually change from a hobby income to your regular income. All right, prizes. Cash prize. Unfortunately, cash prizes for any amount pretty much. Prizes a taxpayer wins by drawing, radio or television contests, any events, they're taxable. Now, it doesn't matter pretty much the amount is the problem. All right, it doesn't matter what the amount is. You do have to report it. It doesn't matter if it's $50. It doesn't matter if it's $25. We actually technically have to report even the $25 gift cards. Okay, they're really important. 5:30 today. Okay. Okay. But all cash prizes need to be reported. Canceled debt. Any of you guys ever had the canceled debt?
Mm-hmm.
It really is a pain in the butt. It's one thing that you're never proud of. It mainly occurs when you have something like a foreclosure or something like that. It
Cancel
is
credit card.
Canceled credit card. There you go.
Forgiveness.
Anytime it's $600 or more, you can have a cancellation of debt, and it's the 1099-C. The lender sends it to you, and you send it with your taxes because you're responsible for the taxes for it. And most people, unfortunately, ask, why do I have this? You know, I don't have that debt anymore. And the hardest part is where you have to explain it. It really becomes hard to do a person's taxes sometimes when they don't understand the actual sources of their income. And unfortunately, because this is a debt form of income that they never saw the money, they don't think of this as income. And a lot of times it's really hard to explain to them. And sometimes it actually hurts to explain this to them because you're trying to explain, like I said, a lot of times this comes from a foreclosure. And when you're talking to a person about something like that, I've had to explain this to a person who had just recently lost the house. They had lost the house about 2 months before this came. So not only had they lost the house, but they got this right afterwards, and it hurt them a lot. They were still recovering from the foreclosure. And to explain to them the fact that they were responsible for responsible for his income as well is sometimes hard. They have received the benefit of it. The hardest one I've ever seen is, as you guys sometimes know, back a number of years ago, anybody heard of the 107 loan? There was a 107. The biggest one I heard was a 145 loan. When the market was doing really, really well back in, like 2004, 2005, 2006, originally. Around 2005, they had a loan, 2004, that what they were willing to do, it started as a 105, then it went to a 107. When you were getting a property, what they were willing to do, because appreciation was going so fast with houses, they were actually willing to give you a loan based on the appraised value of your house for 105% of the value of your house. They knew the house values were shooting up. So they would give you, if your house was $110,000 or $100,000, they would give you $105,000. The idea was you take that additional $5,000 and go furnish your house. Okay, because they knew the house would be worth $105,000 in a couple of months. Then houses went up faster, and they had the 107 loan, and these were actually started to become a stated loan, okay, where they would give you 107% of your value of your house. Finally, the highest I ever saw was a 145 loan. Houses were increasing in value so fast that they gave you 145% of the value of your house. Now, frankly, I consider that pretty much insane, because that means that if your house is worth $100,000, they were willing to give you, based on its value, $145,000. That was the highest I ever saw. This means that if you defaulted on it, not only did you owe the value of your house and were foreclosed on for the house, you also had an additional 45%, which could be, like I said, $100,000 was an additional $45,000 On a $200,000, that would be $90,000. And there were houses that were somewhere around $300,000 and $400,000. $400,000 is an additional $180,000 that you could have taken out of the house. Now, that's a lot of debt. I know of a person who had a 145 loan and defaulted on it, and the value of the house was $200,000. So that means $90,000. I think they were actually over it by about $75,000. They got a cancellation of debt notice. That's a lot to have canceled, $75,000, because that was considered
and they didn't
additional.
qualify for the mortgage forgiveness?
No, this is before the mortgage forgiveness was out.
That sucks.
That sucked. So $75,000 they got hit with. That hurt big time. It took them a long time to recover from it. And
they couldn't count as insolvent or anything?
They actually ended up declaring bankruptcy, and there was nothing else they could do. No, I mean, when you $75,000 in debt just got dropped on top of you, plus you just had a foreclosure, and they had basically been losing everything. But they did have all the new toys that they bought with the $75,000 that they and they had been using it for the past year or something like that. So they weren't able to take any of it back because it was basically about a year old, and the people who they bought it from, all that stuff, all the stores weren't about to take it back after a year. So cancellation of debt of that amount, you get hit with a lot. All right. And when it comes, it shows as basically ordinary income in a sense. It shows under other income for the full amount, and it goes under line 21, and it counts as really painful. So, all right. It's 4:30 already. All right. Awards and bonuses. Same thing. Awards and bonuses, they just show up however you end up with them. Now, non-cash employee achievement awards are not taxable, but all the other ones, all types of achievement awards, that sort of thing, they're all taxable. They go right on your income on line 1. They end up on your W-2. Okay, they're treated as regular wages. So your bonuses, especially for us, unfortunately, our bonuses are all taxable. Our performance bonuses, I wish they weren't taxable, but they're all taxable. So straight up, and they are considered ordinary income. Now, this one gets a little bit different. Court awards and damages. Settlement awards are different than compensatory damages. Settlement awards are things that are, if you sue somebody, lost wages, things like this, where it is a settlement for your loss or something that happened to you, damages to you, something that you were injured, something that you have suffered a loss for. That is what settlement awards are for. Compensatory damages are ones for actual personal injury or sickness. The settlement awards are mainly from lost wages and things like that as a result of it. The compensatory damages are for the actual injury you received. All right, and that's the difference. Emotional distress they're actually on, hey, Honeyco. So, yeah, we'll be done in a little bit. Emotional distress kind of falls as a compensatory damage, but they're normally, if they're related to a physical injury, then it's considered taxable because it is an award. How can I put it? If it's directly related to the injury itself, okay, then it's taxable if you get it because of that court order. If it's not related to a physical injury, like the emotional stress, then it is not taxable. That's where the difference is. If it's something, if your leg was hurt in the accident, then, and you get an award for that injury to your leg, that would be taxable. If, however, because your leg was injured, your back starts to hurt, that sort of thing, because you're not walking correctly, you will have health benefits and whatnot, but it is not a direct result of the injury. So that is not considered taxable. That's not part of the award settlement. Okay. It has to be directly related to the injury itself. All right. We still have a lot to go through. This is only 42. All right, tell you what, it's already 4:40. Questions. Let's go over some questions. What do we have so far?
Oh, questions.
Pam, you're on mute. More? Oh, there you go. I know you were talking. It was like I was watching.
Can we go back a screen for a minute?
Sure. This one?
Yeah. The emotional distress one. So.
Mm-hmm. Damages are awarded for emotional distress if it's directly related to a physical injury. In other words,
And that's taxable.
That's taxable. If something happened, like you have an actual head injury, and as a result, you actually suffer emotional distress as a result of it.
Mm-hmm.
If you have emotional distress because it caused you to be nervous about your bills, be nervous about your situation, your husband, or whatever it may be. Yes, thank you. My wife's over here making comments now. Then no, it's not taxable. Okay, so if you get a settlement and you have emotional distress as a result of it, if it was directly related to the injury, it is taxable. If it is not related to the injury and you get emotional distress and you get a compensation for it, then it is not taxable. So they may actually be required to pay you for the emotional distress that was not related to the injury, and that is not taxable. Only what was, because they may be required to pay for your medical costs, or it may have done something to you. You're now suffering for PTSD would be an example. You may have a physical emotional distress due to an injury you received. But as a result, you also now have PTSD, and that is not directly related to the physical injury. That's a result of having suffered an injury, and they may need to provide you something for it, but that is considered not taxable. It's not directly related to a physical injury.
Okay. I got it.
So that's kind of the difference. Is it's you will have what is a direct physical injury and an indirect emotional distress.
Okay.
It's a little bit harder to explain. It's easier when you actually see it, I guess you could say, but it's not something you ever want to. One is a directly related to the physical injury, where one is associated with it, but not as a direct result.
Okay.
Do you guys know of anybody like that? Usually vets have it in a lot of cases. They'll have something where they actually have a head injury or something like that where it has affected them in some cases emotionally, even they may even have brain damage as a result of an injury received, or emotional distress they have paranoia as a result of it, but as an extension they have PTSD. The paranoia is a result of the physical injury, and the PTSD is a result, it's an extension of it. So the PTSD is not considered related to the physical injury, where the paranoia may be.
Okay.
So, okay. All right. This is still a big chapter, because this gets into inheritance tax. All right, let's do this. Let's call it quits for today, because I still have to upload the other 2 videos.
Okay.
All right. Does that sound good, guys?
Yep.
All right. And then we will get everything going again tomorrow at 2. We'll finish, because there's still 13 slides left of this one.
13?
Yeah, there's still 13 more slides left of this one. That's why I was saying that that's going to be a lot to get into.
Yeah.
The other income part of it is a major part. So, all right.
Okay. Have a good evening.
All right,
everyone.
ladies.
All
Hey,
right,
Beth.
guys.
Beth, can I talk to you for 1 sec?
See you tomorrow.
Bye-bye.
All right, later, guys.
Hey. Hello.
Hey, dear. I didn't mean to say anything bad that way.
That's all right. It's just, sometimes it's like, what are we, stupid?
No, that wasn't my intent. That wasn't what I meant.
We have been tax preparers for years, all of us.
I know, and I didn't mean it that way. So it wasn't meant that way. So that's what I was saying. So it was so. What is that? Lloyd is sending me stuff from Vancouver. Anyway.
Who is Lloyd?
The DM for Southwest Washington.
Oh. So now, how long ago did they split you guys up?
October last year.
Oh, so it was recent.
Yeah, they did it to us right before the season started. They would have done it basically today, something like that. No, not even today. Today's still September. So,
oh,
yes.
Dang.
So they wouldn't have done it until halfway through next month. We had all Southwest Washington. This would have all been Lloyd's area. So all the south part of the state. So
is that what they were talking about when they said that the phone systems changed?
Oh yeah, everything sucked.
Right before?
Good. Yeah, right before. No, they actually switched the phone system. They actually changed it a week before.
Oh.
They actually changed. Mario changed it. Our IT tech guy for the company, he switched it a week before. That was brilliant.
Salem's not. We're not sure when we're going to lose our phone system because we're still on.
But no, but
Cal setup.
Yeah, but no, but I didn't mean anything by that. It wasn't that. It was like, it was. It's just because I teach business, and that's why I was like, it's just when sometimes I get into it when I'm in business because I sometimes get frustrated because it's not you, it's not meant that way. It's sometimes I get frustrated because I'm going, okay, guys, no. Business is you actually, and that's why when I start the business section of the EA courses,
Mhm.
I actually spend literally 2 weeks on that section. 2 weeks on explaining what businesses actually are, because in truth, most people have no clue what a business actually is.
Yeah.
And the reason is most people have a hard time accepting the fact that when a business is formed, you actually do create a living, breathing, legal entity. A person is formed, and that has an entire set of rights and everything of its own.
Yeah, when I ask for those origination papers, they're like, "What?"
Yeah, so no, they don't understand that it actually creates a living, breathing entity that survives on its own even after the original creators are long dead.
And all I was saying was, it's not an actual living organism. It has.
But it does. But that's just it. It really does create one that is alive on its own. It grows on its own. It does everything. It has all the same characteristics of a living, breathing creature, and it does. It will grow on it, and that's why when I have that course, I literally take 2 weeks explaining that, because most people don't have any understanding of that when you do form those articles of incorporation, it's no longer under your control. You can kill it, but even sometimes the original owner can't kill it. Steve Jobs couldn't kill Apple. He was fired from Apple.
Right.
You
You
know?
are not the owner anymore.
Yeah, you're not. It's
CEO.
not you, and it takes on a life of its own as soon as it starts. And most people don't get that. They think, well, I'm the business. No, you aren't. You actually have created a child. Yeah, you have created a child, it's like, and it can do a lot on its own without you.
And your board of directors can kick you out.
That's correct. And the board of directors can get kicked out by the body or the shareholders. And most people don't get that. It's like even a church, most people don't realize a nonprofit actually has shareholders, because in legal terms, the congregation of a church are the shareholders of a church, because they're the ones who actually make the contribution. So they are the shareholders.
That makes sense. Yeah, I had never thought of that.
And so what happens is in court, because church members have had to go to court before because of the church structure, and they're like, what are you talking about? Yeah, it's a non-profit entity, and when you do go to court over it, it falls under all the same privy that a regular corporation does. And people,
the pastor does not own the church.
No, the pastor is actually an employee of the church. Most people don't get that, and actually he's, most of the time, if he's an employee, he's a non-voting member. Most people don't get that. He is actually an employee of the church.
Mm-hmm.
And
yeah, my brother-in-law's pastor.
I'm a pastor, so I'm like, I understand it. I'm an elder of a church. I'm like, I actually am on the council, so I have one of the 5 votes of the, who the pastor even is. So, and it's like, they don't realize that that's the voting council. That's the board of directors and the official documents. So, it's like they don't.
That's why we're in the job we are in, so we can help people understand things.
All right. Well, that's why I do all the tax strategy stuff too, because we do the sole proprietorship has no tax strategy whatsoever. You're responsible for everything, and people are just like, well, I've got a business. Well, you can form the next 30 seconds I can form 10 sole proprietorships. That's how hard it is to form a sole proprietorship, because there is nothing to it. It takes.
What's the difference between Washington and Oregon when forming businesses?
Nothing. Businesses are based upon. They're all basically federal. So the structures, it's only just how you pay the fee and to whom you pay the fee, and certain laws that affect
we went
it.
through the Secretary of State.
You all go through the Secretary of State.
We went through the Secretary of State. And my husband didn't have to be licensed or anything because the type of job he does.
Nope.
And so we just registered. Are other states just like that?
They all do the same.
You just register?
Yep, they all do the same. Then you get your EIN number. Once you get your UBI number from the state, then you send it to the Fed, and you get your EIN number. And guess what? You're incorporated.
We
Then
don't
if
have
you
to have an EIN number.
well, it all depends upon your business. You don't have to have an EIN number. If you're
Yeah.
a sole proprietorship,
We chose. I had him get an EIN number because I was like, "Do you want your social
you're
security number
insane.
floating around?"
You're insane not to get an EIN number, because EIN number allows you to separate yourself from all the stuff, and you wouldn't believe all the benefits you get. You see, there's a liability issue that comes into this too. With an EIN number, it makes it basically an LLC. So the liability now lies within the company versus you. Sole proprietorship, everything is you. If I'm a sole proprietorship and I end up having a house that's under my sole proprietorship, okay, a rental property. Here's my first advice. Let's say you're a person who owns a rental property, right? Bob, who doesn't even live there, is walking down the street and walks up and trips by your thing and breaks his leg and is injured. Guess what? He sues you. Okay, you had a loose brick on it or something that they can show was your neglect. Guess what you're liable for? Because you have it under your sole proprietorship, it is your rental property, that makes it automatically under your sole proprietorship. Guess what you can lose? Your house you're living in, your primary residence, the house, the rental property, your bank accounts, and everything else, because they're not separate. Not separating them is crazy. And they don't understand the liability involved with it. But no, but I was just saying, I apologize. I didn't mean to make it sound like, I was like, no, Beth, you have to understand, it does create a living, breathing life form that has a life all of its own once it's created.
Right.
And
I understand
people are like,
where you're coming from. But I think about the literal side of it. It's not. It doesn't have a heart. It doesn't, bleed.
Right.
Because so that's all I was saying.
I know, and I understand, but like I said, it does form what in legal terms has an entire set of legal rights, because in the eyes of the court, it does form an entire separate person. That's why it has its own EIN number. Its EIN number is the exact same thing as a Social Security number for you.
Yeah, and some W-2s are starting to X out those first numbers just like they would a Social Security number, and I'm like, what the heck?
Yeah, because they don't want everybody to have the first ones.
Yeah.
Mm-hmm. So.
How I can't put this in on the computer because you don't have it.
Because you don't have it. All right. Anyway, I think you got a few phone calls today because I saw my phone ringing throughout the day sometimes. Oh, you're not at the office anyway, so it doesn't matter. So.
No, Cindy had at least 3 Mondays off, so there's been nobody there today.
Cool. Okay. All right. Well, in that case, I just wanted you to know that.
All right.
All right.
Thank you. See you tomorrow.
No problem. I'll talk to you then tomorrow.
Okay.
All right. All right. Bye-bye.
Good night.
Night. You're hamming?